What's up, guys? Mike here again with an ASOS update. Now, this is actually a pretty big deal for me, this update. I thought this was really interesting, what they've announced here after the first period. So that's like September to December, which is the first period of their fiscal year. Now, this looks to me like the company is completely changing directions, and I think this is actually good, and it is more necessary than I realized until now. So just first of all, they announced their sales. There's not a huge update here. The sales were down 3%, and we all expected this. You know, it's a inflation and recessionary kind of environment. Cost of living rises. We expect this stuff, you know, discretionary spending to go down. This is how it is in most fashion, except maybe Shine or Shein, which is really doing well. But everybody else is having problems in fashion. So I don't really care about the updates on the sale perspective. Gross margins, yeah, they came in at 42.9% if we exclude the one-off stock write-downs. And I think that has bottomed. I think that is the bottom print for gross margins, and I will explain why I think that. But if we go back to the big news here, basically one of the quotes from Jose was, "We are trying to materially change the profitability profile of the business." He said that in the update, and in the release he said, "We are no longer going to chase top line growth." So what ASOS is doing is it's no longer jam tomorrow, it's jam today. They want to be profitable now, and that is in contrast to, I think, the previous management's strategy of continually building for the long term, like with the eye on the long term prize. And presumably that's part of the reason that Nick Sleep originally invested these kind of like long-term time horizons where they're investing in the ecosystem and reinvesting in the customer, very low margins. You know, that's sort of the Costco, Amazon model. Now, ASOS is not Costco or Amazon. They don't have that kind of brand moat. It's very difficult for ASOS to have a moat like that, given the industry they're in. So, you know, I'm digressing here, but I wonder if Nick Sleep is still even in this. He actually put out a letter for the first time in forever, and he talked about scaled economy shared, and he used the examples of Costco and Amazon, but there was no mention of ASOS. So I wonder if he's still in this. I don't think that's a reason to buy this company, but it does give an indication that one of these super investors was interested at some point. Okay, so going back to the strategy change. So they've announced that they're going to have $300 million in profitability improvements in this financial year, and I'm shocked by this. I said in the last video, I thought that Jose set the bar too high for himself, and it looks like he's actually on track. Right? They didn't change anything. They said we're still going to improve profitability by $300 million for the year. 2/3 of that's going to come in the second half as they implement all their new strategies. And so strategies like the improved stock management, that's the inventories. They're putting all their geographies through a process. If the geographies can't be profitable, they're going to exit them. Like, more or less, that's the strategy. So I think that's quite good. I don't think they need to be everywhere. I think if they just focus on their key locations like the US, UK, and Europe, that's probably the more efficient use of their time and money. So we might see them leave certain other countries. What else here? They're not really interested in discounting as much anymore. So before they would try and drive sales through sales, through discounting. And now they're going to have their intention is to have more full priced items on the site, which means the gross margins would be better, assuming they can keep the sales level up. Okay, so there's that, and then they're going to increase prices by low single digits, so not a full increase to offset inflation. And I think, you know, I'd some also some efficiencies in their warehouse where they found that they were kind of losing money with these orders that had multiple pieces to them. They would be getting bits from here and there, so they're going to try and improve the efficiencies there. And so they basically said, we're on track to do this stuff, and the benefits will show up in the second half, which is why I think the gross margins have bottomed, barring a sales collapse. Okay, so who knows? Maybe they're going to drop by 10% in the second half in sales, and the gross margins won't move. But I think that the chances of that are fairly low. That's just my guess. I do think there's still some industry tailwinds here for the online retailers, right? There's still, even though the COVID stuff spiked the move to online, and now it's sort of just on the other end of that wave, I do think the long-term trend is still online, and I've seen some forecasts that say that the tailwinds are about 9% there, moving from brick and mortar to online. So I think that kind of stuff is great to have in your back pocket to kind of bail you out in these situations. What else do I want to say about that? Oh, there is an issue here. There's a fairly big issue, actually, I think, and this is something I didn't recognize before. So this is one of the mistakes I've made, and I've had to spend some time sort of recalculating here. They announced that their net debt this period was $400 million, and that is up $250 million from the year-end August number. Right? They did announce they were going to take money out of the revolving line of credit, I think in September. But I thought, oh, that's just going to add to their cash balance. But they've actually gone through, looks to me like probably about $250 million in cash in the first 4 months. So that is a bit of a concern, because this revolver, it matures in July 2024, and they're going to need to be able to pay this down, or else they are at risk of bankruptcy proceedings. Now, I think they'll work something out, but I think their liquidity is less robust than I thought it was previously, so that's my mistake. Now, let's go down that path. Let's say they've got their convertible debt, and they've also got the revolver, net debt of $400 million. They've got $430 million of cash. Let's say they actually don't succeed in their plan, and they continue to burn cash going forward, and they end up in a bankruptcy type situation. I still think there is an asset moat here. Now, we've got a enterprise value of about $1.1 billion market cap plus net debt, and on $3.8 billion in sales, with 26 million customers and some brands that are pretty valuable. The Topshop brand and some of their in-house brands are actually gaining some traction here. I would think that this would be a fairly good acquisition target for some of the bigger players. Like, if you can bolt on 26 million customers and almost $4 billion in sales, typically that type of that size of operation would sell for around 1x sales in the industry. Now, it could be a bit more, could be some less, but even at 50% of sales price, that's a $2 billion sales. That's a $2 billion price tag, and in that scenario, the market cap is worth twice as much, more than twice as much it is right now. So something would have to go, I think, very wrong for this to be worth less than that. Now, if you're let's say we're in bankruptcy, the debt holders are in charge. Then maybe they just fire sale the company for $1 billion so they can get their money back. Maybe that happens, right? They would be in charge of the process, but something tells me that that's fairly unlikely. But it is a risk, so that's the risk here with ASOS. And so going back to the Jose sort of change of direction thing, I did not realize that this change of direction is actually necessary. It's not him going, here's my brilliant plan for the future. It's like they needed to do this because the cash burn was so high. They're investing in their infrastructure for the last few years, and they need to start printing positive cash flows. So I will leave you on this positive note at the end. They have reiterated their guidance about free cash flow for the year being somewhere between negative 100 million and zero. Now you say, how is that good news? Well, if they've already burned 250 million, that means that going forward, it looks like the free cash flow might be positive, between 250 or 150 and 250 million in, let's say, the second half. If that happens, I would definitely expect that the stock would react, right? They would say, oh my God, this thing's printing cash again, right? So 200 million free cash flow in the second half. What do you think the company's worth in that scenario? And the last caveat there is that it's actually not that simple, because they have seasonality where there's outflow to build inventories. Maybe going into Christmas is maybe that's the reason they're actually down 250 million. It's just a seasonal issue. So maybe in the future, it's not really that they're cash flow positive 200 million going forward. Maybe it's just over a course of a year, they are they're printing small free cash flows. And I think in either of those situations, the stock is fairly de-risked. So in summary, Jose is changing direction. It looks like he's succeeding, right? Because he's reiterated these targets. Looks like he has a chance to succeed. If they succeed, I think that the stock revalues, because I think it's priced for failure right now at 700 million market cap, 1.1 EV versus 4 billion in sales. It looks like it's priced for failure. So this is the kind of scenario I like. Possibly not that much downside. It's like a heads I win, tails I don't lose that much kind of scenario. And if they become a very strong cash flow company, you could see this revalue quite hard to the upside. And one other thing, I keep just adding things, but I think if I review my previous thesis, which was I'm waiting for one good year as they grow, they're aiming at 7 billion in sales, and if we get a 4% margin, EBIT margin, at any point between now and then, and get 200 to 300 million in EBIT, I think the stock will revalue hard. So I'm just waiting for a good year. Now, this has changed a little bit because I don't think the upside is 7 billion anymore. They didn't update their long-term revenue projections, which I'm going to want to see when they come out with that. But let's say it's 5 billion over 4 years, right? So even lower. I think what's happened is the EBIT potential here, the margin potential is actually higher now because they're trying to squeeze margins in a bunch of different areas. So let's say the upside EBIT, maybe more like 5 to 7, maybe even 8%, but it would be on a lower revenue number. So let's say the upside here is 7% EBIT on 5 billion sales, right? So then you're up to 350 million in EBIT. To be safe, let's say it's 5 billion in sales over 4 years and 5 billion or 5% EBIT. You're now up to 250 million. Same outcome, right? So you're still in the 200 to 300 range. But I do think with the lower growth rate, you're not going to get the multiples you would have got in the other scenario, right? You see the stock spikes up and spikes down. It spikes up partially because the revenue growth rate has been high. If the revenue growth rate falls to 5-10%, you're not going to see a 30 times earning, 40 times earnings anymore. You're going to see 10, 20, maybe 25 at the upside. That said, I still think if they post one good year going forward, 5% margin, 6% margin, the stock is very undervalued at the moment. But it's a bet that they're able to do that. I don't have any insight, any proof that they're going to be able to do that, but I think they're going to get there. Anyway, thanks for watching again, guys, and I hope you have a great week.